All right, let's talk about something you've probably seen floating around the crypto space and thought, is that for real? We're talking about investments promising returns over 100%. Today, we're going to pull back the curtain on high-yield crypto bonds. We'll figure out how they work, where all that money actually comes from, and of course, what the real risks are. Let's dive in. I know exactly what you're thinking, because it's the first question everybody asks. An APR, an annual percentage rate, of over 100%? Come on, that sounds way too good to be true, doesn't it? So let's unpack how a number like this is even possible in the first place. And yep, you're seeing that right, 116%. That is not a typo. It's a real figure from past performance, and it's exactly the kind of thing we're here to understand. Okay, so let's start with that big flashy number, the one that gets all the attention, the APR. What does it actually mean, and where in the world does it come from? Now, the numbers we've seen from these bonds are, frankly, pretty wild. We're talking about APRs that have consistently shot well over 100%. We've seen 108% and that 116% we just saw. And get this, the rates have stayed above 70% for months at a time. That's just something you don't see in traditional finance. So what's the best way to think about this APR? Well, it's not some fixed, static number. It's way more like a dynamic high score in a video game. When there's a ton of action on the platform, lots and lots of trading, your score, the APR, just skyrockets. Okay, so if the APR is the score, what's the engine actually driving it all? This is the most important part, right? Because a huge number doesn't mean a thing if you don't know where the money is really coming from. And here's the answer. It's actually super simple, and it's totally legitimate. The yield comes from real economic activity. Specifically, it's generated from the fees that real users pay when they trade crypto assets on the platform. That's it. This quote absolutely nails it. There's a direct line here, a really powerful one. The more people trade, the more fees get collected. And it's those fees that are then passed directly to the people holding the bonds, which is what pumps up that APR you see on the screen. A high yield is awesome, but a number on a screen is just, it's a number on a screen. It doesn't mean much until it's actually in your wallet. So how and when do you get paid? Now, this is where it gets really, really compelling. We are not talking about waiting for some monthly statement or an annual payout. No, your rewards are generated in real time, every single second, as trades are happening. And they're immediately available for you to claim whenever you want. And you know what the best part is? This whole thing is basically on autopilot. Trades happen in real time, the platform collects the fees instantly, and those profits start racking up on your bond second by second. They're paid out in USDC, which is a stablecoin pegged to the dollar. Your share is just sitting there, ready for you to redeem whenever you feel like it. No waiting, no hoops to jump through. Of course, even with all that, an APR over 100% with instant payouts, it might still set off some alarm bells. And that brings us to a super important distinction in crypto, the difference between real yield and, the fake stuff. And this analogy just illustrates it perfectly. Real yield is like running a super popular lemonade stand. The money you make is actual cash from real customers buying your lemonade. It's sustainable. Fake yield, on the other hand, is like that same lemonade stand just printing its own lemonade dollars to pay you with. I mean, sure, you feel rich for a minute, but those custom bills could be completely worthless tomorrow. So here's the key takeaway. These bonds pay you in what's called real yield. The profits you get come from actual revenue, those trading fees we talked about. They don't come from just printing a bunch of new inflationary tokens out of thin air that just devalue over time. This is what separates a sustainable model from a total house of cards. All right, ready to level up? We've covered the insane APR and the legitimacy of the yield, but now we're going to get into something really powerful, how a rising crypto market can act like pure rocket fuel for your earnings. This is such a great way to picture it. So imagine your investment is on an escalator. You're earning that high APR, which is kind of like you walking up the steps. You're already making great progress. But what happens when the crypto assets themselves go up in price? Well, the whole escalator starts moving up, carrying you with it. All of a sudden, you're moving way, way faster. Let's just break this down with some simple numbers to make it clear. Let's say you invest 1 Ether when it's worth $1,500. With a 100% APR, you're on track to earn $1,500 in USDC for the year. I mean, that's already a fantastic return on its own. But here's where the real magic can happen. What if the market gets hot? What if the price of that one Ether you invested suddenly doubles? Well, that same 100% APR is now being calculated on a much larger base, $3,000. Your annual yield in dollar terms jumps to $3,000. That's effectively a 200% return on your original cash investment. Your earnings just got totally supercharged by the market. So let's bring this all together now. We've seen the incredible potential for high APR and that market multiplier effect. But it's absolutely essential to understand the full picture. And that includes both the massive upside and, of course, the risk. The big idea here, the main takeaway, is this concept of a potential double win. First, you're earning that great passive income from all the trading fees. And second, if the entire crypto market rises, the dollar value of your income gets a huge boost right along with it. Now, and this is super, super important to remember, this is a two-way street. That same powerful force that can supercharge your earnings, it can also work against you. If crypto prices fall, the dollar value of your underlying investment and your earnings are also going to shrink. So the crucial point is this: your success here is tied to the health of the crypto market. That powerful combination of yield plus asset appreciation comes with that inherent market risk. It's a fundamental part of the deal that you always have to keep in mind. So all of this really leads to one final, pretty big question, doesn't it? We know your yield, your payout, can get supercharged by the market, but what about the bond itself, the actual thing you own? Can its price go up too? Well, that is a fantastic question, and it's exactly what we're going to break down in our very next explainer. Thanks for tuning in.